Hello and welcome to our final installment of Lucky LinkedIn 2025, where we are rounding out the word Shamrock with the letter K or KEOGH plan. Self-employment or working for a small business may sound like a dream. However, one downside is that you likely won't have access to a workplace retirement plan like a 401k. Now, you could max out an IRA by contributing up to $7,000 in 2025, but that just might not be enough to reach your savings goals, and that's where a KEOGH plan can come in. A KEOGH plan is a tax-deferred retirement plan for self-employed people and small businesses. It is similar to a 401k as it is personal and tax-deferred, but it is designed for self-employed and small businesses like doctors, writers, with benefits and tax advantages similar to those who work in a more traditional corporate setting. To use a KEOGH, a small business must be a sole proprietorship, partnership, or limited liability, or LLC. And employees of small businesses owners may also be eligible, but the employer contributes instead of the employee. The IRS now refers to KEOGH plans as HR 10 or qualified plans, though many still use the original term. Technically, however, KEOGH is no longer relevant. While it is used to refer only to plans for self-employed, the law no longer distinguishes between corporate plan sponsors and other plan sponsors. Just as with an IRA, your KEOGH plan can hold stocks, bonds, mutual funds, and CDs. When you contribute to a defined contribution or defined benefit plan, those contributions are taken from your taxable salary. Then in retirement, distributions are taxed as ordinary income. You can withdraw by the age 59 and a half, although you don't have to begin withdrawing until you're age 73, 75 if you were born in 1960 or later. Early withdrawals are still subject to taxes and a 10% penalty unless there are qualifying physical or financial circumstances. If you continue working into your 70s, you can contribute, but must also take your required distribution. What are the different types of KEOGH plans? Well, similar to other types of retirement plans, they have two basic types, a defined contribution plan and a defined benefit plan. Defined contribution plans allows employers to define their contribution. Within this bucket, there's two subtypes, a profit sharing plan and a money purchase plan. With profit sharing plan, you don't have to show a profit to contribute. You decide how much to contribute to your plan each year. The amount can change from year to year as well. Profit sharing plans come with a cap on how much you can contribute, but anything under that amount is fair game. On the other hand, a money purchase plan requires you to contribute a fixed percentage of income every year. And in 2025, this can go up to 25% of the compensation amount or $70,000, whichever is less. You decide the percentage at the outset. You cannot change the amount if the company profited that year. You could face a penalty if you change the percentage or don't contribute 1 year. The other kind of KEOGH plan is a defined benefit plan, which determines the annual benefits you'll receive in retirement. A defined benefit plan works kind of like a traditional pension, but you fund it yourself. You can contribute up to 100% of your compensation to this plan. The IRS has the exact formula to calculate your contribution. Your salary, years of employment, expected return on assets, and other stated benefits will determine the contribution amount. Now, the pros and cons of a KEOGH plan. They do provide several benefits for self-employed people. Their contribution limits are higher, meaning more money goes into the account, which could be especially beneficial for older high-income earners. KEOGH plans also offer small business owners and even some employees tax-favored retirement savings. Small business employers may also deduct the contributions made for their employees. However, the KEOGH plans pose some problems as financial tools are somewhat complicated. They often require tax and financial advisors to handle the paperwork involved. Hiring a professional is one more step a taxpayer can make to ensure that the numbers and calculations come out correctly. Now, KEOGH plans also require more upkeep than, say, a simplified employee pension or SEP, simple IRAs or 401k plans, which means these costs can add up. Further, specific plans will require your contributions each year to meet a minimum funding standard. This still applies even if you're a bit strapped for cash. KEOGH plan contribution limits for 2024 and 2025. If you have a profit sharing plan, you can contribute however much you choose, not including contributions for yourself. For 2025, you can contribute less than 25% of your compensation or $70,000. That's for 2025, up from $69,000 in 2024. You can contribute a fixed percentage of yearly income if you have a money purchase plan. The contribution amount will come from the IRS formula. Again, you can contribute up to 25% of compensation without including your contributions if you have a defined benefit plan. Your contributions depend on the benefit you set and other factors. It would help you to have an actuary determine your actual amounts. Otherwise, there are no other contribution limits. Your maximum annual benefit in 2025 is capped at $280,000, which is up from $275,000 in 2024, or 100% of your compensation, whichever is less. When searching for the best retirement plans, you'll have to carefully consider several plans, especially if you're self-employed or a small business owner. A KEOGH plan may not be the best of the available options, say a SEP IRA or solo 401ks or even individual 401ks. However, when looking at plans, you won't want to forget that these qualified plan structures exist. Have a plan in place for your business? Wonderful. When's the last time you had it reviewed? Reach out to us here at Compass Consulting. We'll help you put a plan in place, or we'll do a review of your existing plan and see if there's anything we can help you do to reach your retirement goals. Thank you, and we'll see you guys again next year.